Welcome to FXED Insights, where we break down the world of Forex trading.
One deep dive at a time.
You got it.
Well
Today,
done.
we are strapping in for a wild ride through the fundamentals.
Yeah.
Think of it as Forex 101,
Uh-huh.
but hold on to your hats because we're ditching the textbook
Absolutely.
and taking you straight to the trading floor.
That's right. We are cutting through the noise, giving you the insights you need to navigate this exciting
Yeah,
but often overwhelming market.
for sure.
We'll be covering everything from what Forex actually is.
Yeah.
The risks that keep seasoned traders up at night.
Oh, yeah.
The opportunities that make it so alluring.
Uh-huh.
And the steps to take if you're ready to dip your toes in the Forex waters.
We've been in this game for over a decade,
A long time.
seen the market soar and crash.
Oh, yeah.
And learned a thing or two along the way.
Yeah.
So consider us your seasoned guides,
Mm-hmm.
here to share the hard-won wisdom and hopefully a few laughs along the way.
We believe knowledge is power, especially in a market as dynamic as Forex. So
Absolutely.
let's start by demystifying the basics. What exactly is Forex trading?
All right, let's break it down. I think most people have dabbled in Forex without even realizing it. Imagine you're at the airport, about to jet off on that dream vacation, and you're exchanging your dollars for euros.
Right.
That, my friends, is a basic Forex transaction.
Precisely. It's the exchange of one currency for another.
Uh-huh.
But in Forex trading, we're not just swapping cash for a trip abroad. We're speculating on the fluctuating values of different currencies, aiming to profit from those tiny and sometimes not so tiny shifts in exchange rates.
So instead of buying souvenirs, we're
Hmm.
buying and selling currencies, hoping to make a profit from their changing values.
Yes,
It's like a global dance of currencies, and we're trying to predict the next move.
you got it. It's all about timing and strategy, a bit like surfing those currency waves. And here comes the reality check.
Uh-oh.
Those waves can get pretty choppy.
Speaking of choppy waters, let's talk about the risks. I remember when I first started trading, I was so focused on the potential profits that I completely underestimated the risks.
It's a common mistake, especially for newcomers.
Yeah,
One of the biggest pitfalls is market volatility.
right.
Currency prices can change faster than you can say pip,
Oh, man.
influenced by
No.
everything from economic news to geopolitical events. Even a tweet from a certain someone
Oh, yeah.
can send the market into a frenzy.
Oh, tell me about it. I once lost a decent chunk of change because I didn't factor in a surprise interest rate hike.
Oof.
Talk about a lesson learned the hard way.
Those hard lessons are often the best teachers, though. That's why we're here to equip you with the knowledge to navigate those risks. Another one that trips up many traders, both newbies and veterans, is the allure of leverage.
Ah, leverage. It's the double-edged sword of Forex trading.
It is.
Can you break it down for our listeners who might not be familiar with this concept?
Think of leverage as a turbocharger for your trades. It allows you to control a larger position with a smaller amount of capital, amplifying your potential profits. But, and this is a big cinchana, but it also magnifies your losses.
It's like driving a high-performance sports car. It can get you to your destination faster, but it also requires more skill and control to handle.
Right.
One wrong move and you could end up in a ditch.
Exactly. Leverage can be a powerful tool when used wisely, but it's crucial to understand the risks involved and use it cautiously.
So how does someone manage these risks? Are there any life jackets we can wear in this Forex ocean?
Absolutely. One of the most important strategies is setting stop-loss orders.
Okay.
It's like having an insurance policy for your trades.
Gotcha.
A stop-loss order automatically closes your position at a predetermined price level, limiting your potential losses.
So it's like setting a safety net, saying if the market goes against me this far, I'm out. That way you're not clinging to a losing trade, hoping it will magically turn around.
Exactly. It's about protecting your capital and preventing those small losses from turning into account-draining disasters. Another risk management strategy is diversification.
Okay.
Don't put all your eggs in one currency basket.
Right.
By spreading your trades across different currency pairs, you can reduce your exposure to any single currency's fluctuations.
It's like having a diversified investment portfolio, not putting all your money into one stock. It's a classic principle of risk management, and it applies equally to Forex trading.
You nailed it. Now let's shift gears a bit and talk about the flip side of risk the opportunities.
Yeah.
What makes Forex such an attractive market for so many traders?
Well, for starters, it's the largest financial market in the world, trading trillions of dollars every single day. That's a lot of zeros.
It is.
This massive liquidity means you can enter and exit trades quickly and easily without worrying about getting stuck in a position.
That's right. And unlike the stock market, which operates on limited hours, Forex is open 24 hours a day, 5 days a week.
Oh.
You can trade whenever it suits your schedule, whether you're an early bird, a night owl, or somewhere in between.
That 245 access is a game changer, especially for those who have day jobs or other commitments.
Right.
You don't have to be chained to your desk during regular business hours to participate in the Forex market.
Another attractive feature of Forex is its relatively low barriers to entry. You don't need a fortune to start trading. Many brokers offer accounts with low minimum deposits, making it accessible to a wider range of investors.
That's a big plus.
Yeah.
You don't need to be a Wall Street tycoon to get started. Now, let's say someone is intrigued by the world of Forex and wants to embark on this trading journey. What are the essential steps they need to take?
First and foremost, education is key. Don't just dive in head first without understanding the basics. Take the time to learn about how the Forex market works, different trading strategies, and crucially, risk management techniques.
Knowledge is power, especially in a market as dynamic and complex as Forex. There are tons of resources available online, from educational articles and videos to webinars and courses. You can even find demo accounts offered by brokers that allow you to practice trading with virtual money.
Those demo accounts are like a flight simulator for Forex traders.
Yeah.
You can test different strategies, get comfortable with the trading platform, and build your confidence without risking any real money. It's a great way to learn the ropes before you step onto the real trading floor.
And speaking of the trading floor, choosing a reliable Forex broker is another crucial step. There are a lot of players out there.
Right.
So it's important to do your research and find a broker that aligns with your trading style,
Yes.
offers a user-friendly platform, and most importantly, is regulated by a reputable financial authority.
That's right. Regulation provides a level of security and ensures that the broker adheres to certain standards.
For sure.
You don't want to entrust your hard-earned money to a fly-by-night operation.
Absolutely. Choosing a broker is like choosing a financial partner.
Yeah.
You want someone you can trust who has your best interests at heart. And remember, don't be afraid to shop around. Compare different brokers, their fees, their platforms, their customer support, and choose one that feels like the right fit for you.
Welcome back to FXED Insights. In part 1, we set the stage, covering the basics of Forex, the risks and opportunities, and the steps to take if you're ready to jump into the world of currency trading. But like any good adventure,
Right.
the journey doesn't end there.
That's right.
Yeah.
We've only just scratched the surface. Now it's time to equip you with the tools and techniques to navigate this exciting but often complex market. Think of this as Forex 201. We're going beyond the textbook and diving into the strategies that can help you make informed trading decisions.
And before we get into the nitty-gritty of charts, patterns, and indicators, let's revisit a concept we touched upon earlier: risk management.
Yeah.
It's not the most glamorous aspect of trading,
Right.
but it's the foundation of consistent success.
It's kind of like building a house. You wouldn't build on a shaky foundation.
All right.
Right. No matter how beautiful the design, if the foundation is weak, the whole thing could crumble. Risk management is that solid foundation for your trading.
Precisely. No matter how brilliant your trading strategy, if you don't manage your risk effectively, you're setting yourself up for potential disaster. It's like walking a tightrope without a safety net.
So what are some of the key principles of risk management that every trader from newbie to seasoned pro should keep in mind?
One of the most fundamental principles is to never risk more than you can afford to lose. Sounds simple, right?
Yeah.
But it's easy to get caught up in the excitement of trading, especially when you see those winning streaks.
I've been there. It's like going to Vegas with a budget, but then getting caught up in the moment and throwing caution to the wind. Not a good strategy for your wallet or your trading account.
Definitely not. Always determine your risk tolerance before entering any trade
And set stop-loss orders to limit your potential losses. Those stop-loss orders are your safety nets. They're like having an emergency brake on a runaway train. You're essentially saying, if the market goes against me this far, cut my losses. It takes the emotion out of the decision-making process.
Another key principle is diversification. Don't put all your eggs in one basket. In Forex terms, that means don't just trade one currency pair. Spread your risk across different currencies to reduce your exposure to any single currency's fluctuations.
It's like the old adage, don't put all your money in one stock.
Yeah.
You want to create a portfolio that can weather the storms of the market.
Now let's dive into the strategies.
Okay.
There's a whole universe of trading strategies out there, each with its own advantages and drawbacks. Some traders rely on technical analysis, which is all about studying price charts and using indicators to identify patterns and trends.
It's like being a detective looking for clues in those charts to predict the market's next move.
Exactly. It's about identifying those recurring patterns that suggest where the market might be headed.
So let's break down some of those technical analysis tools. What are some common chart patterns that traders use to spot potential trading opportunities?
One common pattern is the head and shoulders pattern.
Okay.
It's called that because it literally looks like a head with two shoulders on either side. When this pattern forms, it often signals a reversal in the market trend.
So if you see a head and shoulders pattern forming on a chart, it might be a sign that the market is about to turn bearish, even if it's been in an uptrend.
Exactly. Another popular pattern is the double top and double bottom.
Okay.
These patterns indicate potential support and resistance levels in the market.
Think of it like a bouncing ball. The double top is like the ball hitting a ceiling and bouncing back down,
Right.
while the double bottom is like the ball hitting the floor and bouncing back up.
A simple but effective analogy. These patterns can help traders identify potential entry and exit points for their trades.
Now let's talk about technical indicators. What are they, and how do they help traders make sense of the market?
Technical indicators are mathematical calculations based on price and volume data. They're like little assistants that help traders interpret the data and confirm their observations.
It's like having a team of experts whispering in your ear, giving you their insights on the market.
Some popular indicators include moving averages,
Right.
which helps smooth out price fluctuations and identify trends, MCD, which helps identify changes in momentum,
Yeah.
and RSI, which helps gauge overbought or oversold conditions.
It's important to note that indicators are just tools. They shouldn't be used in isolation, but rather as part of a comprehensive trading strategy.
Absolutely. They provide additional insights but should always be used in conjunction with other forms of analysis. Now let's talk about another approach to trading fundamental analysis.
Fundamental analysis is all about looking beyond the charts and understanding the bigger picture. It's about analyzing the economic and political forces that drive currency movements.
That's right. It involves keeping an eye on economic indicators like GDP growth, inflation, interest rates, and employment data, as well as staying informed about political events and news that can impact the market.
It's like being a global news junkie, constantly monitoring events around the world to see how they might ripple through the Forex market.
One key principle of fundamental analysis is understanding how interest rates affect currency values. Generally, currencies with higher interest rates tend to attract more foreign investment,
Right.
which can drive up their value.
So if a country raises its interest rates, its currency might strengthen as investors seek higher returns. It's all about supply and demand on a global scale.
Exactly. Another important factor to consider is economic growth.
Right.
Countries with strong and growing economies tend to have stronger currencies.
It makes sense. A healthy economy attracts investment and boosts confidence in the currency. So how do traders use fundamental analysis to make trading decisions?
They might look for currencies that are undervalued based on economic fundamentals, or identify currencies that are likely to strengthen due to positive economic news or policy changes.
It's like being a financial detective looking for clues in the economic landscape to predict which currencies are poised to rise or fall.
Now, many traders combine both technical and fundamental analysis to make more informed decisions. It's like having two lenses to view the market,
Yeah.
each providing a different perspective.
It's like having a toolbox with both a hammer and a screwdriver. You wouldn't use a hammer to tighten a screw about it. You choose the right tool for the job. And the same applies to trading strategies.
Now, we've talked a lot about strategies and analysis,
Yeah.
but there's another crucial element to trading that's often overlooked: psychology.
The mind games of trading. We touched on this briefly in part 1, but it's such an important topic that it deserves its own deep dive. Welcome back to FXED Insights, traders. We've covered a lot of ground from the basics of Forex and risk management to technical and fundamental analysis.
Yeah, we have.
But the journey doesn't end there.
Nope.
In this final part of our deep dive,
Right.
we're going to explore the mental game of trading, the psychology that can make or break even the most seasoned trader.
That's right. We're entering the zone where psychology meets strategy, where discipline and emotional control become your most valuable assets. Think of it as Forex 301,
I like it.
where we unlock the secrets of a trader's mindset.
I like to call it the inner game of trading. You can have the best strategy in the world, but if your mind isn't in the right place,
Right.
you're going to struggle.
It's like being an athlete.
Yeah,
You can train your body to perfection, but if you're mentally unprepared, you're not going to perform at your best.
for sure.
Trading is no different.
So let's talk about some of the psychological pitfalls that traders both new and experienced often fall into. What are some of the common biases and mental traps that can sabotage our trading decisions?
One of the most common is confirmation bias.
Oh, yeah.
It's that pesky tendency to seek out information that confirms our existing beliefs, even if it's blatantly contradicting the evidence.
It's like wearing those rose-colored glasses, only seeing what you want to see, not what's actually there. And in trading, that can be a recipe for disaster.
Absolutely. You might be so convinced that a certain currency pair is going to go up that you ignore all the warning signs pointing to a downturn.
I've been there. I once held on to a losing trade way too long because I was so sure it would eventually turn around. I kept looking for any scrap of news or data that supported my belief while conveniently ignoring all the evidence to the contrary.
That's a classic case of confirmation bias,
It is.
and it's a trap that can cost traders a lot of money. Another common bias is loss aversion.
Yep.
It's the tendency to feel the pain of a loss more strongly than the pleasure of an equivalent gain.
It's that feeling of, ugh, I hate losing more than I love winning.
Right.
And it can lead us to make irrational decisions, like holding on to losing trades in the hope of avoiding a loss, even when it makes more sense to cut our losses and move on.
Exactly. It's like clinging to a sinking ship, hoping it will magically resurface even though it's taking on water fast.
Oh.
Sometimes the best decision is to jump overboard and swim to safety.
So how do we overcome these biases and develop a more disciplined and rational mindset?
One key is to develop a solid trading plan and stick to it. Your plan should outline your trading goals, risk tolerance, entry and exit rules, and money management strategies. It's like having a roadmap for your trading journey.
It's like having a set of rules for the game, a constitution for your trading decisions. It takes the emotion out of the equation and helps you make objective decisions based on your predefined strategy.
Another key is to practice mindfulness and self-awareness. Pay attention to your thoughts and emotions and recognize when you're being influenced by biases.
It's like becoming an observer of your own mind, noticing those thought patterns and emotional triggers that can lead you astray. And once you're aware of them, you can start to challenge them and make more conscious choices.
Absolutely. And don't underestimate the importance of taking breaks and managing stress.
Right.
Trading can be an intense and demanding activity. And it's important to step away from the charts and recharge your mental batteries.
That's so true. I used to get so caught up in the market that I'd forget to eat, sleep, or even take a break. I was constantly checking charts, obsessing over every pip movement. It wasn't healthy or sustainable.
It's like running a marathon without stopping for water or rest. Eventually, you're going to hit a wall. Trading is a marathon, not a sprint. Pace yourself, take care of your mental and physical well-being, and you'll be in a much better position to make sound trading decisions.
So we've talked about the psychological traps and the importance of discipline and self-awareness. Now let's talk about the mindset of a successful trader. What are some of the qualities and habits that set apart the winners from the rest?
Successful traders are often characterized by their patience, discipline, and resilience. They understand that trading is a long game and that there will be ups and downs along the way.
They don't get rattled by every loss or chase after every quick win. They stick to their plan, manage their risk, and learn from their mistakes.
They're also adaptable and continuously learning. The Forex market is constantly evolving, and successful traders are always looking for ways to improve their skills and knowledge.
They're like those martial artists who are always honing their craft, always seeking new techniques and insights. They never stop learning, never stop growing.
And finally, successful traders have a positive mindset. They believe in their ability to succeed and don't let setbacks derail their journey.
They know that every loss is a learning opportunity, every challenge a chance to grow stronger. It's about embracing the journey with all its twists and turns and never giving up on your dreams. Well, folks, we've reached the end of our deep dive into the fascinating world of Forex trading. We've covered a lot of ground from the basics to psychology, and hopefully we've equipped you with the knowledge and insights to navigate this exciting market.
Remember, trading is a journey, not a destination. It's a continuous process of learning, adapting, and growing. Embrace the challenge, stay disciplined, and never stop pursuing your trading goals.
And remember, we're here to support you every step of the way. So keep those trading minds sharp, and we'll catch you on the next episode of FXED.